Okay, let's unpack this. Imagine a company that benefits from booming gold prices, from all the mining activity and exploration in the world, without ever having to dig an ounce of dirt themselves. They don't own the mines, they don't operate them, and they aren't bogged down by those, day-to-day operational headaches. Sound intriguing? Today we are diving deep into Franco-Nevada Corporation, or FNV, a name that's generating a lot of buzz in the investment world. Our mission for this deep dive is really to extract the crucial insights from an in-depth investment analysis and recent company reports. We want to understand what makes FNV's business model so distinct, what its real opportunities and challenges are, and why it holds such a unique position in the precious metals market. What makes this story particularly compelling, though, is the central tension we found in our sources. On one hand, FNV is absolutely capitalizing on a robust precious metals market, with record gold prices fueling record financial performance in 2024 and 2025. Record performance. But on the other hand, the company is grappling with a material headwind, the unexpected production halt and subsequent full impairment of its cornerstone Cobre Panama streams in late 2023. This dichotomy, immense tailwinds versus a significant sudden blow, really sets up a fascinating narrative for us to explore today.
Yeah, it's really fascinating here because, Franco-Nevada isn't your typical mining stock at all. Many people hear gold company and immediately picture like heavy machinery and hard hats, but that's just not FNV. This deep dive will really clarify how their unique royalty and streaming model works, why it's considered by many to be, well, a superior way to gain exposure to precious metals, and what that means for anyone looking to understand not just mining, but innovative investment strategies in general. We're going to peel back the layers on everything from their impressive financial health and incredibly diverse portfolio to those significant headwinds they're navigating, ensuring you get a complete nuanced picture of this really interesting company.
So let's jump right in then. What truly separates Franco-Nevada from the pack, and why many see it as a gold standard investment, it really boils down to its unique royalty and streaming model. Can you break down what that actually means and why it's considered such a powerful approach compared to owning, say, a traditional mining operation?
Right. This raises an important question right off the bat. What exactly is a royalty and streaming company? Because it fundamentally flips the traditional mining script on its head. Unlike conventional miners, Franco-Nevada doesn't own or operate mines. They don't manage the development of projects, nor do they conduct geological exploration themselves. None of that. Instead, they act purely as a specialized capital provider to the mining industry. Think of them as financiers, maybe, but with a very specific strategic return mechanism that gives them a piece of the action without the operational headache.
Okay, so financiers, but focused just on mining returns. How does that work in practice?
Well, the way it works is quite brilliant, actually. Franco-Nevada provides upfront financing to mining operators, the companies that do own and run the mines. In return for this capital, FNV acquires long-term interests in the future production from those specific assets. These interests primarily take two key forms.
Two forms. Okay, what are they?
The first is a royalty. This is essentially a contractual right to receive a percentage of revenue or profit from a mining operation. Now, the most common type in Franco-Nevada's portfolio is called a net smelter return, or NSR royalty. Think of it this way. FNV gets a share of the pie after the miner pays for essential costs like transportation and refining, but before the miner calculates their own profit.
Ah, okay. So after some costs, but not all of them, they get a slice of the top line, more or less.
Exactly. So if a miner extracts and sells gold, FNV gets a cut of that revenue without having to bear any of the ongoing operating costs involved in getting that gold out of the ground or managing the mine day to day. They just get a percentage of the net revenue minus those specific deductions.
Okay, that's royalties. What's the second form?
The second form is a stream. These are metal purchase agreements that involve a large upfront payment from Franco-Nevada to the mining company, a big chunk of cash upfront. In exchange for this lump sum, FNV gets the right to purchase a fixed percentage of a mine's future metal production at a predetermined, deeply discounted price.
Deeply discounted. How deep are we talking?
Well, for example, in a typical gold stream, Franco-Nevada might pay only, say, 20% of the spot gold price for each ounce delivered over the life of the mine.
Wow. 20% of spot. That's a massive discount.
It is. It's a significant guaranteed discount, regardless of what the future operating costs are for the miner. So to recap, royalties are a slice of the revenue, streams are a prepaid right to buy metal super cheap. Both put FNV in a powerful low-cost position relative to the commodity price.
Okay, that makes sense. So they're not shoveling dirt, but they're getting a share of the gold. either as revenue or at a massive discount.
Oh.
What are the big structural advantages of this model? Why is it considered superior to traditional mining?
Right, the superiority claim. It really boils down to three core structural advantages, I'd say. First, and this is crucial, insulation from cost inflation. Once FNV acquires a royalty or stream, they aren't responsible for any portion of the mine's ongoing operating expenses or future capital costs. Think about that.
So no exposure to rising labor costs, fuel prices, equipment maintenance.
Exactly. As those mining costs escalate, which they consistently do in this industry, traditional miners' margins get squeezed. But for FNV, their margins on fixed cost streams actually expand in a rising commodity price environment.
How does that work?
Because their revenue per ounce goes up with the gold price, but their cost per ounce, say that 20% of spot price, stays fixed or moves much less, so their profit margin widens. It's an incredibly powerful dynamic, especially in inflationary times.
Okay, that's a huge one. What's the second advantage?
Second, this non-operating nature leads to exceptionally high profitability and scalability. We're talking about incredibly high margins. For example, the report mentions that in 2024, the company generated an adjusted EBITDA margin of 86%.
86%. That's astronomical for most industries.
It is, and it's incredibly scalable because they have a lean corporate team of approximately 40 employees overseeing a global portfolio of more than 430 assets.
Wait, say that again. 40 employees for over 430 assets.
40, give or take. That's a feat utterly impossible for a traditional miner, which would require thousands of employees, massive overheads, complex logistics, you name it. This lean structure translates directly into industry-leading metrics such as revenue and cash flow per employee.
Wow, only 40 employees for over 430 assets. That really puts into perspective the lean nature of this model. It also means less exposure to the day-to-day headaches of running a mine, like labor disputes, equipment breakdowns, or unexpected geological issues, right?
Absolutely. Less overhead, more profit potential per dollar invested. Essentially, huge operational leverage without the operational burden.
Okay, so insulation from costs, high profitability and scalability.
Yeah.
What's the third advantage?
The third is diversification. Unlike single mine companies or even larger traditional miners that might rely heavily on a few key assets, royalty companies like Franco-Nevada build vast portfolios. This diversifies risk across numerous assets, different commodities, various operators running the mines, and multiple geographies. This structure effectively mitigates the impact of a single adverse event, like a mine shutdown or a geopolitical issue at one particular location, which, as we'll definitely discuss later with Cobre Panama, can be a major concern for any mining investment. It's a formula designed for resilience.
That efficiency and insulation from mining headaches sounds almost too good to be true. It makes me wonder, are they alone in this space, or is it a crowded field, and how do they stack up against anyone else trying this model?
Good question. The royalty and streaming sector is actually quite concentrated. It's dominated by a few large, well-established players. Franco-Nevada's primary competitors are Wheaton Precious Metals, ticker WPM, and Royal Gold, RGLD. Now, a significant recent industry event that's shaping this landscape is the acquisition of Sandstorm Gold, that's SSL, by Royal Gold. That deal was valued at approximately US $3.5 billion.
Okay, consolidation.
Yeah, announced in July 2025 and expected to close later this year, Q4 2025. The strategic rationale behind this consolidation is very telling and actually, well, quite validating for Franco-Nevada's approach. The merger aims to create a larger, more diversified, and more liquid entity. The thinking is that this new combined company will be capable of competing for bigger deals and attracting a wider institutional investor base. But what's fascinating here is that this merger essentially serves as a strong validation of the very strategy Franco-Nevada has successfully executed for over a decade. By consolidating, the industry is effectively confirming that scale and diversification command a premium valuation, which is exactly what Franco-Nevada has meticulously built its business on.
So other companies are essentially trying to catch up to FNV's playbook.
Yeah.
That positioning must reinforce Franco-Nevada's leadership then, right?
That's how the analysis frames it, yes.
But with this consolidation, aren't they just creating bigger, more aggressive competitors? Does a larger Royal Gold Sandstorm pose a new kind of threat? Or is FNV truly insulated?
That's a perceptive question. And the sources suggest it reinforces FNV's leadership. Franco-Nevada is already the largest company in the sector by market capitalization, and crucially boasts the most diversified portfolio by number of assets, with over 430 interests. That's a key differentiator. While their strategy is primarily gold-focused, they've also opportunistically diversified into energy and other minerals, which further strengthens their unique position. So as the undisputed leader on both fronts, market cap and asset diversification, Franco-Nevada's existing valuation premium relative to its peers may very well be reinforced.
Okay, so leadership reinforced. But what about competition for new deals?
Right. Regarding your point about new threats, it's actually quite interesting. The absorption of Sandstorm, which was historically known for being a very aggressive and nimble competitor, might actually lead to a more rational competitive environment for new deal opportunities.
Huh. Less competition.
Potentially. With one less aggressive bidder in the mix, it could potentially make it easier for FNV to secure new, attractive deals on more favorable terms. So it's not necessarily about insulation, but about maintaining their lead and perhaps facing a slightly less heated bidding environment for new assets.
Interesting dynamic. Can you give us some numbers to compare them?
Sure. To give you a clearer picture, if we look at a peer comparison matrix from the analysis, some key data points really stand out. For market capitalization, Franco-Nevada is around $35.7 billion USD. Wheaton Precious Metals is approximately $41.6 billion CAD, which converts to roughly $30 billion USD, give or take exchange rates. And the Royal Gold pro forma after the Sandstorm merger will be around $14.6 billion USD.
Okay, so FNV is clearly the largest by market cap.
Correct. Then, when it comes to total assets, FNV has that remarkable 430 assets. Wheaton has around 35, much more concentrated. And the Royal Gold pro forma will have approximately 400, closer to FNV after the merger, but still fewer. This starkly highlights FNV's superior diversification by sheer number of assets.
And profitability.
In terms of profitability, Franco-Nevada's adjusted EBITDA margin is cited around 87%. Wheaton's is roughly 75%, and Royal Gold is about 80%. That 87% for FNV clearly stands out and speaks volumes about the efficiency of their specific model and asset mix.
Wow. And commodity mix, are they all just gold plays?
Mostly, but with nuances. For FNV, revenue is approximately 80% precious metals. Wheaton is higher at 94% precious metals, but it's split differently. About 57% gold and 37% silver. Royal Gold is about 87% precious metals, heavily weighted to gold at around 75%. So while they all lean heavily into precious metals, FNV has that strategic, opportunistic diversification into other areas like energy, about 14%, which sets it apart and offers a different kind of risk profile.
And geography, are they spread out globally?
The geographic exposure for FNV is heavily concentrated in the Americas, around 86% of revenue. This is actually quite similar to its peers, indicating a shared focus on what are generally considered stable mining jurisdictions, North and South America primarily.
That's a potent combination of leading market cap, unparalleled asset diversification, and superior margins. So it sounds like not only is Franco-Nevada already at the top of the heap, but the recent industry consolidation, like the Royal Gold and Sandstorm merger, actually reinforces FNV's strategy. It might even make the market less competitive for them when it comes to finding new deals. They're not just surviving, they seem to be thriving in a consolidating market.
Let's zoom in on the portfolio itself then. You mentioned this vast and diversified collection of assets, 430 of them. What does it actually look like quantitatively, and how does that deep diversification protect the company from risk, especially given the challenging environment we hinted at earlier with Cobre Panama?
Right. The depth and breadth of Franco-Nevada's portfolio diversification is truly the cornerstone of their strategy and their primary defense against risk. It's not just a talking point, it's structurally embedded. As of early 2025, the company holds interest in, yes, an astounding 430 assets. To break that down quantitatively from the reports, 119 of these are producing assets, actively generating cash flow right now. Okay, 119 cash generators.
Then another 38 are in an advanced stage, meaning they're nearing production, providing near-term growth visibility. And then a remarkable 273 are exploration stage assets. That's the long-term pipeline. This robust structure provides both immediate, stable cash flow from the producers and significant long-term growth potential from that development and exploration pipeline.
And it's this spread that protects them.
Exactly. This portfolio structure isn't just about raw numbers, it's a strategic shield. A critical risk management tenet for them, mentioned in the analysis, is that no single asset is expected to contribute more than 15% of revenue in 2025.
Ah, the 15% rule.
Yes. And this policy in particular proved absolutely critical following the Cobre Panama shutdown. It showed just how deliberate and necessary their diversification is.
Let's break down that diversification further. What about by commodity? We know it's mostly gold, but what else?
Okay, let's look at this diversification by commodity using the Q2 2025 revenue figures from the source table. Gold accounts for 70% of their revenue, which is clearly their core focus. Silver adds another 10%.
So 80% gold and silver.
Right. Then platinum group metals, or PGM, contribute 2%. But importantly, energy, primarily oil and gas royalties, makes up 14%. And iron ore and other minerals account for the remaining 4%. Overall, precious metals accounted for a solid 82% of their revenue in that quarter. But that 14% in energy and the other 4% provide a crucial hedge, softening the blow if precious metals face a downturn, something many of its peers don't have to the same extent. It's not just diversification, it's strategic diversification.
Okay, and geographically, you said concentrated in the Americas.
Yes, in terms of geographic diversification, also based on Q2 2025 revenue, South America leads at 38%, Canada contributes 20%, the United States is 16%. Central America and Mexico together make up 12%, and the rest of the world is 14%. What's notable here is the heavy concentration in the Americas, totaling 86%. These are generally considered stable and established mining jurisdictions, which adds a layer of geopolitical stability to their operations, though, as we'll see, nowhere is entirely risk-free.
That's a huge number of assets across various commodities and mostly stable geographies. It really highlights how they spread their bets. Now, without Cobre Panama, which we know was a cornerstone, what are the current big cash generators for FNV? What are the key assets holding things down now?
That's a very pertinent question. With Cobre Panama currently offline, it's even more important to understand the other cornerstone assets that are driving cash flow. These are all operated by large, well-capitalized, and technically proficient mining companies, which is key. This forms a stable and predictable cash flow base for Franco-Nevada.
Okay, who are the big ones?
For first, there's Candelaria in Chile, operated by London Mining. This is a gold and silver stream on a very large, long-life copper mine. Franco-Nevada is entitled to 68% of the payable gold and silver produced until certain delivery thresholds are met, which they anticipate happening around 2027.
And after 2027?
After that, the stream entitlement reduces to 40%. Still significant. This asset has an impressive mine life extending out to 2051 and is expected to deliver a significant 60,000 to 70,000 gold equivalent ounces, or GEOs, to Franco-Nevada in 2025.
GEOs, right, the standard measure. Okay, Candelaria, who else?
Then we have Antapaccay in Peru, operated by the giant Glencore. This is another gold and silver stream linked to copper production from a major mine. The structure here is a bit different. Until mid-2028, FNV receives a fixed amount of gold and silver per ton of copper concentrate shipped.
And after mid-2028?
Thereafter, it converts to 30% of the gold and silver produced by the mine. This asset is expected to contribute between 40,000 and 50,000 GEOs in 2025, so another big contributor.
Okay, two big copper mine streams in South America.
Yeah.
Any others?
Also in Peru is Antamina, operated by a joint venture that includes major players like Teck and BHP. Here, Franco-Nevada holds a silver stream, specifically on Teck Resources' 22.5% share of production from one of the world's largest copper-zinc mines. The mine life here was recently extended to 2036 with significant further resource potential. FNV expects to receive 3.1 to 3.3 million ounces of silver from Antamina in 2025. That's a pure silver stream.
Millions of ounces of silver, okay. And one more.
Finally, there's Guadalupe Palmarejo in Mexico, operated by Core Mining. This is a 50% gold stream on a well-established silver-gold complex. It's actually been a foundational asset for Franco-Nevada since way back in 2009. It's a steady producer, expected to generate between 45,000 and 50,000 GEOs for the company in 2025. So you see, these four assets, Candelaria, Antapaccay, Antamina, and Guadalupe Palmarejo, form the bedrock of FNV's current revenue stream, ex-Cobre Panama.
Those are some serious cash cows operated by major mining companies. But you also mentioned a substantial number of exploration stage assets, 273 of them, if I recall correctly. That's a huge number. How do those contribute to the value if they're not even producing yet? Is that where this concept of free optionality comes in?
Exactly. That's precisely it. Beyond these direct cash flows from producing mines, a crucial yet often undervalued component of the Franco-Nevada thesis is what the analysis calls free optionality embedded within its portfolio. The company holds royalties on over 70,500 square kilometers of exploration ground. That's a vast area.
70,000 square kilometers.
Hooray!
Here's the ingenious part. When another company invests its own capital in exploration on this land and successfully discovers a new deposit or expands an existing reserve, the value of Franco-Nevada's royalty interest increases automatically.
Automatically, meaning FNV doesn't have to put in more money. Correct. With zero additional investment required from Franco-Nevada, They benefit purely from the operator's exploration success on ground where FNV already holds a royalty. This dynamic has played out repeatedly throughout the company's history. A famous example mentioned is its original gold strike royalty in Nevada. It was initially just a small interest on exploration ground that ultimately grew into one of the world's most significant gold deposits after the operator, Barrick Gold, made a massive discovery there.
Wow. So they just sat back and watched the value of their royalty explode.
Essentially, yes. This perpetual discovery option across such a vast and prospective land package represents a significant source of potential long-term high-margin growth that is not typically captured in standard valuation models. It really is like a hidden gem in their portfolio.
So essentially, they get a free ride on all the exploration efforts of other companies across a huge land area. That's a truly ingenious way to capture upside, without the downside risk of having to fund that risky exploration themselves, creating what the report calls free optionality. It means they benefit from future discoveries without lifting a finger or spending an extra dime, which is a powerful differentiator that really sets them apart. Just pure upside potential baked in. Beyond their unique model and this deeply diversified portfolio, Franco-Nevada is also riding some powerful waves in the broader market. Let's talk about the macroeconomic environment for precious metals. What's driving the current buzz, and how is it playing into FNV's strengths?
You're absolutely right. The macro environment for precious metals has been exceptionally strong through 2024 and into 2025, and this provides a powerful tailwind for a company like Franco-Nevada. Gold prices in particular have surged, surpassing previous records. The analysis notes they traded above $3,000 per ounce and averaged $2,860 per ounce in the first quarter of 2025.
$3,000 gold. That's remarkable. Is it expected to last?
Well, according to the sources, major financial institutions are projecting this strength to continue. There are forecasts mentioned for average prices to exceed $30,600 per ounce by late 2025. Obviously, forecasts are forecasts, but that kind of sustained strength is a huge boost for FNV's revenue potential.
Okay, so strong prices. What's driving them?
Several powerful macroeconomic forces are converging here. First, there's monetary policy. With inflation remaining somewhat persistent, markets anticipate that the U.S. Federal Reserve will eventually begin a cycle of interest rate cuts. Lower interest rates decrease the opportunity cost of holding non-yielding assets like gold. Essentially, if bonds aren't paying much, gold looks relatively more attractive.
That's
So
right.
it makes gold more competitive in an investment portfolio.
Makes sense. Lower rates, better for gold. What else?
Yeah. Secondly, geopolitical and economic uncertainty. Heightened global tensions, ongoing conflicts, concerns over global economic stability. All of this has significantly enhanced gold's traditional role as a safe haven asset and a store of value. When the world feels uncertain, people tend to flock to gold, and we've certainly seen plenty of uncertainty in recent years.
The fear trade.
Exactly. But perhaps the most significant structural shift in the market, according to the analysis, is the aggressive and sustained purchasing of gold by global central banks.
Yeah.
It's like a quiet, geopolitical gold rush happening behind the scenes.
Central banks buying gold. Why?
For the third consecutive year, the report states, central banks collectively bought over 1,000 tons of gold in 2024. That's a huge amount. This activity is largely driven by emerging market banks seeking to diversify their reserves away from the U.S. dollar. It's created a strong and consistent source of demand that provides a solid floor under the gold price. This isn't just speculative buying. It's seen as a fundamental change in market dynamics, creating sticky, price-insensitive demand.
That's a fascinating structural shift. So central banks are effectively de-risking their national piggy banks, slowly moving away from relying so heavily on the U.S. dollar. How does this connect to the broader mining industry and its capital allocation? Does this environment create more opportunities for FNV?
Absolutely, it's a direct connection. The broader mining industry is currently undergoing a period of intense strategic realignment, which is creating a very fertile environment for royalty and streaming transactions.
Right.
We've seen a wave of consolidation and what our sources call mega deals sweep the sector in 2024-2025. Miners are actively reshaping their portfolios.
How so? What are they buying and selling?
They're often divesting non-core assets, maybe older mines or assets in less favored commodities, to finance acquisitions of assets focused on future-facing commodities. Think particularly copper, which is absolutely critical for the global energy transition. EVs, renewables, grid upgrades all need tons of copper.
Right, the electrification metal.
Precisely. And this industry pivot directly benefits Franco-Nevada. As major mining companies prioritize immense capital expenditures for large copper projects, which require huge amounts of financing, they become more motivated to monetize the precious metal byproducts from these mines. Gold and silver often occur alongside copper.
So they need cash for copper, and selling a stream on the gold-silver byproduct is a way to get it.
Exactly. Selling a gold and silver stream is an efficient, non-dilutive way for these operators to raise a portion of the required capital without issuing more equity, which shareholders hate, or taking on more debt, which might already be high. And Franco-Nevada, with its deep capital resources, its billions in available capital, and its extensive experience in structuring these complex, large-scale stream agreements on copper mines, remember Candelaria, Antapaccay, Antamina we just discussed, they are a logical and preferred partner for these operators. Consequently, the mining industry's strategic focus on copper and other energy transition metals directly expands and enhances the pipeline of high-quality, long-life streaming opportunities available to Franco-Nevada. So it's a perfect storm of favorable conditions. Gold prices are soaring due to global uncertainty and central bank buying, and the mining industry itself is undergoing a transformation that positions Franco-Nevada perfectly to be a key financier for these massive copper projects by taking the gold and silver off their hands. It sounds like they're absolutely in the right place at the right time, with their business model perfectly suited to these macro trends. Given all these factors, the model, the portfolio, the macro tailwinds, let's look at the numbers. How has Franco-Nevada's financial performance actually played out, especially considering that major challenge we touched on earlier with the Cobre Panama impairment? Has their resilience truly shown through in the financial statements?
That's an excellent question, and the numbers tell a really fascinating, albeit initially stark, story when you look at the headline figures. A review of Franco-Nevada's full year 2024 results reveals the profound impact of the Cobre Panama shutdown. On the surface, the headline numbers were indeed stark. Revenue declined 9% year-over-year to $1.11 billion. And gold equivalent ounces, or GEOs, sold fell 26% to 463,334. Ouch! Down 9% revenue, down 26% GEOs. That sounds pretty bad.
It does on the surface. And those numbers certainly caught the market's attention, painting a picture of a company severely impacted. However, and this is crucial, these headline numbers actually mask the underlying strength and incredible resilience of the core portfolio. When Cobre Panama's contribution is excluded from both years, so you're comparing apples to apples without that specific asset, 2024 revenue actually increased by 15% and adjusted EBITDA grew by 16%.
Wow, okay, so ex-Panama, the rest of the business grew double digits.
That's right. This growth was primarily driven by those higher gold prices we discussed and solid performance from the rest of the diversified portfolio. This demonstrates, in very practical terms, the effectiveness of the company's diversification strategy. It allowed them to absorb the loss of a cornerstone asset while still growing the underlying business. It truly showcased their resilience in action.
What about the bottom line, the net income? That must have taken a hit from the impairment.
Yes, the most dramatic year-over-year change on their financial statements was the swing from a net loss of $466.4 million in 2023 to a net income of $552.1 million in 2024.
A swing from loss to profit. How did that happen if revenue was down?
It wasn't due to a sudden operational turnaround. It was almost entirely attributable to the non-recurrence of the massive $1.17 billion non-cash impairment charge related to Cobre Panama that was recognized in 2023.
So the big loss in 2023 was a write-down. The profit in 2024 was simply because they didn't have that write-down again.
Exactly. So the financial impact of Cobre Panama was indeed significant, hitting the books hard in 2023. But it was largely a one-off accounting event, not a fundamental deterioration of the rest of the business, which, as we saw, actually grew.
Okay, that clarifies the 2024 picture. What about more recently? How are things looking in 2025?
Now, let's look at their more recent performance in the second quarter of 2025, because this is where the leverage of their model really shines through. The company's results for this quarter truly showcase the immense leverage of their business model to higher commodity prices. Franco-Nevada reported a series of record financial metrics. Record revenue of $369.4 million, which was a remarkable 42% increase year over year.
Up 42%? That's huge.
Huge. Operating cash flow soared to $430.3 million, up 121% year over year, and adjusted EBITDA reached $365.7 million, a 65% increase year over year. Record numbers across the board.
Okay, but how much did their actual production, the GEOs sold, increase? Was it just higher prices driving this?
That's the key point. What's critical to understand here is that these record results were achieved on a GEO sales volume increase of only 2%.
Only 2% volume increase led to a 42% revenue jump.
Precisely. The primary driver was a substantial 40.2% year-over-year increase in the average realized gold price they received.
Wow, that really shows the leverage.
Absolutely. And this performance resulted in a near perfect adjusted EBITDA margin of 99.0% for the quarter.
99%. Is that even possible?
Apparently so for that quarter. It's a clear, almost textbook demonstration of how rising commodity prices flow directly to the bottom line for a royalty and streaming company with minimal associated cost increases. It perfectly illustrates the inherent advantages of their business model when the market is strong.
So while the Cobra Panama shutdown looks severe on paper, stripping out that one-off accounting impact, the core business actually grew strongly in 2024. And the Q2 2025 results, with that almost 100% EBITDA margin, truly underscore how powerful their model is when gold prices are high. It's an incredible demonstration of resilience and how their unique structure shields them from many of the typical mining industry's vulnerabilities. Given their strong financial position and the resilience we just discussed, how's Franco-Nevada planning to grow from here? What's their strategy for deploying their considerable capital? Are they looking for more of the same, or are there new frontiers they're exploring?
Franco-Nevada's financial strategy is really anchored in conservatism and long-term thinking, which profoundly influences their capital allocation framework. Management consistently emphasizes its policy of avoiding long-term debt. This is a crucial strategic choice.
Why no debt? Isn't leverage sometimes good?
For them, the advantage is that avoiding debt ensures that capital is always available to deploy during cyclical downturns in the resource sector. That's often when the most attractive investment opportunities arise, maybe when other companies are distressed or need cash, allowing FNV to get better valuations. As of December 31st, 2024, the company had, as the report states, no debt and an impressive $2.4 billion in available capital. That's comprised of cash on hand and their undrawn credit facility.
2.4 billion. That's a serious war chest.
It is. And this financial strength is a significant competitive advantage. It allows the company to act decisively on large transactions without needing to access volatile equity markets or dilute existing shareholders by issuing new stock.
Have they been putting that capital to work?
Oh, yes. Management has been very active in deploying this capital advantage, particularly through acquisitions. In 2024, the company executed over $1.3 billion in new acquisitions and commitments. That made it the most active year in its history for deal-making.
$1.3 billion in 1 year. What kind of deals were they?
Two recent transactions highlighted in the analysis really show the company's strategic focus. One was the acquisition of a royalty on the Côté gold mine. This is one of Canada's newest and largest gold mines, operated by IMG Lee, a Tier 1 asset in a top jurisdiction. The other was a $250 million acquisition of a royalty on the Arthur project. This is a major new gold discovery in Nevada, again, one of the world's premier mining jurisdictions operated by AngloGold Ashanti.
So Canada and Nevada, both very stable, top-tier mining locations.
Exactly. These deals demonstrate a very clear strategy, acquiring high-quality, long-life assets in politically stable, top-tier jurisdictions.
Is that part of a larger plan to de-risk the portfolio, maybe consciously shifting away from some less stable regions, especially after an event like Cobre Panama?
Precisely. That's how the analysis interprets it. This strategy not only adds significant long-term growth to the portfolio, but also serves to de-risk it by increasing the proportion of assets located in North America. Management has indicated that the deal pipeline remains robust, suggesting further acquisitions are likely in the near future as they continue to identify and secure these strategic opportunities. It's a proactive move to strengthen the portfolio's overall resilience.
Okay, so growth through acquisition is key. What about growth from within their existing portfolio? Any organic growth coming?
Yes, that's the other important part of the growth story. Beyond M&A, Franco-Nevada also has a visible path to organic growth from assets already within its existing portfolio. This isn't dependent on future deals, it's built-in growth. Management has guided, according to the sources, that growth through 2028 will be driven by numerous mine expansions at existing operations where they hold royalties or streams, and also the ramp-up of up to 9 new mines in which it holds an interest that are scheduled to come online.
9 new mines coming online. That's significant internal growth.
It is, and more immediately, for the second half of 2025, higher GEO contributions are expected from the ramp-up of the Tocantinzinho mine, those newly acquired Côté and Porcupine assets in Canada, and increased deliveries from Antapaccay in Peru. This built-in organic growth provides a baseline level of expansion that is independent of future deal-making. It adds a layer of predictability to the company's medium-term outlook, which investors usually like. It's a very powerful combination of both strategic acquisitions and organic development from within.
So they're sitting on a massive pile of cash, ready to snap up top-tier assets, particularly in stable North American jurisdictions, And they also have a clear growth trajectory from their existing portfolio, thanks to mine expansions and new mines coming online. The powerful two-pronged approach that really sets them up for future success, blending opportunistic external growth with predictable internal growth. Very compelling. Now let's confront the elephant in the room, the Cobre Panama situation. We've alluded to it several times as a major setback. What exactly happened, and what's the current status of this critical asset, and how did Franco-Nevada navigate such a significant, sudden challenge?
Right. The Cobre Panama situation is indeed the most significant and acute challenge Franco-Nevada has faced recently. And frankly, it serves as a stark reminder of geopolitical risk inherent in the mining industry, even for royalty companies. What happened was, back in November 2023, following widespread public protests in Panama and a subsequent Supreme Court ruling there that declared the mine's operating contract unconstitutional, the Cobre Panama mine was ordered to halt operations. It had to enter a phase of preservation and safe management.
Halt operations completely, just like that.
Pretty much. It was an abrupt and severe blow, not just for the operator, First Quantum Minerals, but also for Franco-Nevada. This wasn't just any asset in their portfolio. Cobre Panama was a cornerstone asset for Franco-Nevada. It had contributed a substantial 128,599 gold equivalent ounces in 2023 alone. That's a huge chunk of production.
Over 128,000 GEOs, gone overnight. How did FNV react financially?
The shutdown prompted the company to take a very prudent accounting approach. They recognized a full impairment charge of $1.17 billion in their Q4 2023 financial statements.
$1 billion write-down.
Yes. This effectively wrote the carrying value of the asset down to nil on their books. It reflected a worst-case scenario from an accounting perspective. Consequently, Franco-Nevada's 2024 and 2025 guidance assumes zero contribution from the mine.
Zero, except
for an expected one-time sale of about 10,000 GEOs in 2025. This is from concentrate that was already processed and sitting on site at the time of the shutdown, which they expect to be able to sell. But otherwise, nada.
That's a huge financial hit and a complete removal of a key asset from their guidance. So, from an investment perspective, the downside risk from Cobre Panama seems largely realized and accounted for, at least on paper. But what's the path forward? Is there any hope, or is it a complete write-off in reality?
Well, the future of Cobre Panama remains highly uncertain. That's the honest assessment. But there have been some cautious glimmers of optimism, perhaps. First, Franco-Nevada has done what you'd expect. They've initiated international arbitration proceedings under the Canada-Panama Free Trade Agreement. They're aiming to enforce their rights and protect their investment through legal channels. That process takes time, though.
Okay, legal action underway. What about on the ground in Panama?
Simultaneously, there's been a change in government. The new Panamanian administration, which took office in mid-2024, has expressed a willingness to engage in discussions with the mines operator, First Quantum Minerals, about finding a path forward. That's a more constructive tone than before.
A willingness to talk is better than nothing. Any other factors?
Furthermore, the analysis suggests public sentiment in Panama itself appears to be shifting, perhaps towards favoring a restart. This seems largely driven by the realization of the mine's significant economic impact.
How significant?
It contributed up to 5% of the country's entire GDP and supported tens of thousands of jobs, directly and indirectly. The economic reality of the shutdown is hard to ignore, and this shift in public opinion could be crucial for political will. So this whole situation isn't just a challenge. It creates what investors call a highly asymmetric risk-reward profile.
Asymmetric risk-reward. That's a term you hear a lot in high-stakes investing. Explain that in this context.
Okay, so think about it this way. The downside seems largely realized. The company's accounting, their guidance, and likely the market's valuation have already priced in a worst-case zero-value scenario for the Cobre Panama asset. They wrote it down to zero.
Right. The bad news is arguably already in the stock price.
Exactly. So any positive development, whether it's a negotiated agreement to restart the mine, even partially, or a favorable outcome in that arbitration process, would represent significant, unmodeled upside. It would be a bonus not currently reflected in expectations.
So upside potential with limited further downside on this specific issue.
That's the idea. A full restart at historical production levels, while maybe not the most likely scenario right now, could potentially increase Franco-Nevada's total annual GEOs by approximately 30%. That would be a material boost to revenue and cash flow that is definitely not currently baked into the price or forecasts.
So the market has essentially written off Cobre Panama, meaning any positive news, even just a glimmer of hope or slight shift in public sentiment, could have a disproportionately large impact on Franco-Nevada. It's a high-stakes situation, absolutely, but with potential for substantial upside that isn't currently priced in, truly making it an asymmetric scenario for investors, where the potential gains could far outweigh any further specific losses from this asset. Beyond the assets in the market, the quality of management and governance is always crucial for investors looking at long-term value. What does Franco-Nevada's leadership look like, and how do they align with shareholder interests and modern expectations around things like ESG?
Franco-Nevada's leadership team is consistently cited as a significant strength. It includes individuals who are part of the original company. Figures like Seymour Schulich and Pierre Lassonde are founders or key early figures, giving them deep institutional knowledge and credibility in the royalty model itself. This team has a long and, frankly, very successful track record of disciplined capital allocation and value creation. The analysis points out they've grown the company's revenue by an impressive 8.1 times since its 2008 IPO. That's significant growth.
Disciplined capital allocation. How does that align with shareholders?
A key element of their philosophy, mentioned in the reports, is a sharp focus on increasing net asset value, NAV, and cash flow per share. This is a crucial distinction. They're not just pursuing growth for the sake of getting bigger, they focus on metrics that directly benefit existing shareholders on a per-share basis. This aligns management's interests directly with those of shareholders, which is exactly what you want to see for long-term value creation.
Okay, strong track record, aligned with shareholders. What about ESG? That's increasingly important.
Absolutely. And in an era where environmental, social, and governance, or ESG, factors are increasingly critical for investment decisions, Franco-Nevada is highlighted as an established leader, particularly within the mining space, which often faces scrutiny. The company consistently receives top-tier ratings from major ESG agencies. For example, the analysis notes it was named the #1-ranked gold company by Sustainalytics, received an AA rating from MSCI, which is very high for a resource company, and was rated prime by ISS ESG.
Top marks across the board. What does that reflect?
These leading scores reflect a proactive approach to risk management and corporate responsibility, which is becoming non-negotiable for many large institutional investors. It suggests they're managing non-financial risks well. Furthermore, the company has reportedly met its diversity targets, with 40% representation of diverse persons at both the board and senior management levels. This strong ESG profile makes the company more attractive to a wider base of institutional investors and reduces the risk of exclusion from ESG-mandated funds, broadening its appeal and potentially supporting its valuation.
An ESG leader in mining is certainly a compelling differentiator in today's market. But what about direct shareholder returns? How does this conservative long-term approach translate into tangible benefits for the people holding their stock? Dividends.
That's where their dividend policy really stands out. A cornerstone of Franco-Nevada's investment proposition is its unwavering commitment to shareholder returns through its dividend. The company has an extraordinary record. It has increased its dividend in each of the last 18 years.
18 consecutive years of dividend increases. In mining, that's incredible.
It truly is a remarkable feat of consistency in the typically volatile mining industry. And their dividend policy is deliberately not tied directly to the gold price or any specific financial metric.
Why not? Wouldn't shareholders want bigger dividends when gold is high?
Their stated objective is different. It's to provide a sustainable and progressively growing dividend through all parts of the commodity cycle. They aim for predictable growth, not volatile payouts. This demonstrates management's confidence in their long-term cash generation ability, regardless of short-term price swings, and their ability, as highlighted in the analysis, to announce a 5.6% dividend increase for 2025, even after the massive Cobre Panama shutdown and impairment, is a powerful testament to the cash-generative strength and resilience of their diversified portfolio. It sends a strong signal.
That really does speak volumes.
Since its IPO, the company has returned over $2.5 billion to shareholders via dividends, underscoring their commitment to consistent returns over the long haul.
It's clear that their leadership is not just experienced, but also deeply committed to shareholder value and responsible business practices, all while navigating a complex global industry. An 18-year dividend increase streak, even through significant market volatility and a major asset impairment like Cobre Panama, truly speaks volumes about their discipline and the underlying strengths of the business model. So we've covered the business model, the market, the financials, and the leadership. Now let's tie it all together with how the market values a company like Franco-Nevada and what risks are still on the horizon that investors need to be aware of. What does that royalty premium really mean for you as an investor thinking about valuation?
Right, valuation. The market consistently awards royalty and streaming companies like Franco-Nevada a significant valuation premium compared to traditional mining companies. You'll see them trade at higher multiples.
And that's justified.
The analysis argues it is. It's seen as a rational reflection of the superior business model we've been discussing. Investors are willing to pay a higher multiple, a higher price for each dollar of earnings or cash flow, for a business that offers leveraged upside to commodity prices without the corresponding exposure to operating risks, capital cost overruns, and margin compression from inflation that traditional miners face. The royalty model's inherently higher margins, the greater predictability of cash flows, and that embedded exploration optionality, that free ride on discovery, are all valuable attributes that command this structural premium in the public markets.
Okay, so they get a premium compared to miners. How does FNV compare to its direct peers like Wheaton and Royal Gold?
Historically, Franco-Nevada has generally traded at a premium even to its direct peers, Wheaton Precious Metals and Royal Gold.
Why is that?
This premium is generally attributed to its larger scale, its greater diversification by asset count. Remember, 430 versus 35 for Wheaton before the merger. Its strong debt-free balance sheet, that consistent dividend growth track record we just talked about, and often a perceived management quality advantage. However, it's worth noting, as the analysis points out, that the newly combined Royal Gold Sandstorm entity will present a more formidable competitor in terms of scale and diversification. This could potentially narrow that valuation gap between FNV and RGLD over time as the market digests the new entity.
What metrics should people look at?
Investors typically look at key metrics like price to earnings, PE, price to cash flow, PCF, enterprise value to revenue, EV revenue, and critically for resource companies, price to net asset value, PAVV, with these comparisons and understand relative value within the peer group and versus history.
And how does FNV's valuation behave over time?
Looking at their historical valuation, Franco-Nevada's valuation multiples, particularly price to cash flow, tend to correlate quite closely with the price of gold itself. During periods of rising gold prices and positive sentiment, the multiple expands as investors pay more for each dollar of cash flow, anticipating future growth. Conversely, the multiple tends to contract during gold bear markets or periods of uncertainty. Understanding this historical relationship is key for you, as a potential investor, to assess if the stock is trading at a relative premium or discount compared to its own history and the gold price environment at any given time. It provides context beyond just today's price.
That makes perfect sense. The market prices and the potential, but also the prevailing sentiment and, of course, the challenges. Now, on to the flip side. What are the key risks still lurking that even FNV's robust model can't completely avoid? What should a prospective investor be watching out for?
Right. Now for a comprehensive risk assessment, because no investment is without its challenges, no matter how strong the model appears. The most significant risk facing Franco-Nevada, bar none, is commodity price volatility. The company's revenue, cash flow, and earnings are directly correlated with the prices of gold, silver, platinum group metals, and to a lesser extent, oil and gas. While their business model protects margins from operating cost inflation, a sustained and significant downturn in the price of gold, for instance, would still have a material negative impact on the company's financial results and, inevitably, its valuation. It's a gold-leveraged play, fundamentally, so gold prices matter immensely.
Okay, commodity price risk is number one. What else?
Then there's counterparty and operational risk. The shutdown of Cobre Panama is the definitive and painful case study for this category. Franco-Nevada is entirely dependent on its third-party operating partners, companies like London, Glencore, Teck, Kerr, to actually explore, develop, permit, and operate the mines in its portfolio. Any event that disrupts production at a key asset, think about a labor strike, a major technical failure like a pit wall slide, a significant accident, or adverse regulatory action against the operator, will directly reduce the revenue Franco-Nevada receives from that asset. They don't control the operations.
Diversification helps there, right?
Absolutely. The portfolio's extensive diversification is the primary mitigation for this risk. However, the company still derives a substantial portion of its revenue from its top 4 to 5 producing assets. So there remains a degree of concentration risk, even with 430 assets, that warrants attention. If one of the big ones goes offline, it hurts.
Got it. Next risk.
Geopolitical and jurisdictional risk is another important factor. And again, the Cobre Panama event highlights its acute nature in the mining industry. It can change very quickly. A significant portion of Franco-Nevada's portfolio, despite recent efforts, is still located in Latin America, including major assets in Peru, Chile, and Mexico. These jurisdictions, while often resource-rich, can be subject to political instability, sudden changes in mining and tax laws, or even waves of resource nationalism. An adverse political or regulatory change in a key country of operation could materially impact the economics of Franco-Nevada's assets located there, even if FNV itself isn't the direct target.
You mentioned they're buying more in North America.
Yes, and the analysis interprets the company's recent large acquisitions in the stable jurisdictions of Canada and the United States as a deliberate strategic effort to mitigate this very risk by increasing the portfolio's weighting towards lower-risk regions. It's a smart move, but the Latin American exposure remains significant.
Okay. Geopolitical risk. Anything else?
Finally, there's acquisition and integration risk. With that debt-free balance sheet and over $2 billion in available capital, a key risk for Franco-Nevada is actually the effective deployment of this capital. It sounds like a good problem to have, but deploying it wisely is crucial. The company's growth strategy is heavily reliant on making value-accretive acquisitions. There's always a risk of overpaying for assets, especially in a competitive M&A environment where everyone's chasing good projects, or perhaps of misjudging the technical or geological merits of a project before buying the royalty or stream. A significant misstep on a large acquisition could lead to future impairments and the destruction of shareholder value. So their disciplined approach to capital allocation we discussed earlier isn't just desirable, it's absolutely essential to avoid these pitfalls.
So while the royalty model offers inherent advantages, it's simply not without its own set of distinct risks, from the broad strokes of commodity prices to the very specific challenges of relying on external operators and the complexities of global politics and deal-making. It's a delicate balance of reward and potential pitfalls that requires careful consideration. To wrap up this deep dive, then, let's bring together the core arguments for and against investing in Franco-Nevada, encapsulating the bull and bear cases presented in our sources. What's the final distillation for you, the informed learner listening in?
Okay, let's summarize. For the bull case, the argument for Franco-Nevada is really anchored in its status as a best-in-class operator with what is widely considered a superior high-margin business model. It provides that leveraged gold exposure, but with mitigated operational risk compared to traditional miners. Their pristine, debt-free balance sheet and substantial liquidity, that $2.4 billion, represent a powerful strategic weapon. It positions them as a capital provider of choice in a consolidating mining industry where many potential partners are often capital constrained and need financing options like streams. There's also a clear multi-year growth runway ahead that's driven by both the recent landmark acquisitions they have made in stable, top-tier jurisdictions like Canada and Nevada, and a deep organic growth pipeline from existing assets ramping up production or expanding. Add to that the strong macroeconomic backdrop for gold, fueled by persistent central bank buying and ongoing global geopolitical uncertainty, providing a powerful tailwind for the entire business.
And the Cobre Panama factor in the bull case.
Crucially, yes, the market appears to have fully priced in a worst-case scenario for the Cobre Panama asset. This creates that compelling asymmetric risk-reward profile where any positive resolution or restart, a settlement represents significant unmodeled upside potential. And finally, this is all complemented by that peerless track record of dividend growth 18 consecutive years and industry-leading ESG credentials, which appeal to a broad and stable long-term investor base. That's the bull case in a nutshell.
Okay,
Yep.
compelling bull case. Now, what about the other side, the bear case?
On the bear case side, the primary counter-argument really centers on the unresolved Cobre Panama situation. The uncertainty surrounding its future will likely continue to act as an overhang on the stock, potentially limiting valuation multiple expansion until there is a clear resolution one way or the other. A definitive, permanent loss of the asset, while hopefully mitigated somewhat by the prior impairment, would still remove a major long-term growth driver from their portfolio.
So Panama uncertainty is number one for the bears.
Definitely. Secondly, the company's financial results are highly levered to the price of gold. We saw the upside leverage, but the downside leverage exists too. A significant correction in gold from its current elevated levels would lead to a sharp decline in revenue, cash flow, and consequently, the company's stock price. That's just the nature of the beast.
Execution risk.
Yes. Having deployed a record amount of capital in 2024, the company faces execution risk on those deals and future ones. A miscalculation on a major acquisition, overpaying or misjudging the geology could result in a value-destructive outcome down the line. Their track record is good, but the risk is always there when spending billions.
And
Finally, despite those recent strategic moves to increase its North American weighting, the portfolio remains meaningfully exposed to geopolitical risks, particularly in Latin America. The possibility of another disruptive political or regulatory event in a key jurisdiction like Peru or Chile, while perhaps remote today, cannot be entirely dismissed, as the Cobra Panama situation so starkly demonstrated. That risk lingers.
So what does this all mean? Franco-Nevada presents a truly fascinating case study. It's a company with an exceptional business model, robust financials, and strong leadership. But it's also navigating significant geopolitical uncertainty and inherent industry risks that, while mitigated by their model and diversification, are always present in the resource sector. It's a nuanced picture, blending undeniable strengths with very real challenges.
Yeah, and if we connect this to the bigger picture for you, the learner, it really highlights how critical understanding the business model is, not just the commodity it tracks, like gold. This deep dive should really clarify that even in the seemingly straightforward world of precious metals, there are incredibly sophisticated ways to participate and manage risk. Franco-Nevada's model is a prime example. It also underscores the profound importance of strategic diversification. That proved invaluable for Franco-Nevada when their cornerstone asset, Cobre Panama, went offline almost instantly. Without that broad portfolio and the discipline it represents, the impact could have been far, far more severe for the company.
Exactly. It's a reminder that even the strongest companies face challenges, and how they anticipate, structure themselves, and respond really defines their resilience. And for us, it's fascinating to see how innovation in financial structures can genuinely transform a traditional industry like mining, creating a distinct niche that offers unique advantages. And, yes, its own set of unique risks. So here's something to mull over as we wrap up. In an increasingly uncertain world where governments seem more keen than ever to protect their natural resources and public sentiment can swiftly turn against major projects, will the royalty and streaming model, which deliberately distances companies like Franco-Nevada from direct operational control and some of that direct political risk, become not just a superior investment model, but perhaps an essential one for the future of global resource financing? Think about that for a while.